start by understanding what FDIC insurance actually is. The Federal Deposit Insurance Corporation, or FDIC, is a government agency that protects your money in the bank. If your bank fails, the FDIC steps in to make sure you don't lose your insured deposits up to a certain limit. This coverage applies to checking accounts, savings accounts, and even certificates of deposit. It's a safety net for your hard-earned cash, giving you peace of mind that your funds are secure no matter what happens to your bank. But how do taxes come into play with this insurance? Let's explore further. FDIC insurance covers most types of deposit accounts, including checking, savings, and certificates of deposit. It does not cover investments like stocks, bonds, or mutual funds. The standard insurance amount is $250,000 per depositor, per insured bank for each account ownership category. This means if you have multiple accounts at the same bank, your coverage could be higher depending on how the accounts are structured. Knowing what's protected helps you plan your finances and understand where your money is safest. You deposit money into an FDIC-insured bank, your funds are automatically protected up to the insurance limit. If the bank fails, the FDIC pays you back the insured amount, usually within a few days. This process is automatic and doesn't require you to sign up for extra coverage. The insurance is backed by the US government, making it one of the safest ways to keep your money. But what happens when you earn interest on these accounts? That's where taxes come in. The interest you earn on your FDIC-insured accounts is considered taxable income. This means that even though your principal is protected by the FDIC, the government still expects you to pay taxes on the money you make from interest. Each year, your bank will send you a tax form, usually a 1099 INT, showing how much interest you earned. You'll need to include this amount when you file your taxes. So while FDIC insurance keeps your money safe, it doesn't shield you from taxes on your earnings. It's important to understand that FDIC insurance and taxes are two separate things. FDIC insurance protects your deposits from bank failure, while taxes are applied to the income you earn, such as interest. The insurance doesn't reduce your tax bill, nor does it increase it. They operate independently, but both play a role in your overall financial picture. This distinction helps you manage your expectations and plan your finances more effectively. Every year, your bank will send you a statement detailing the interest you earned on your FDIC-insured accounts. This information is reported to the IRS, and you are required to include it on your tax return. Even if you don't withdraw the interest, it's still considered income for tax purposes. Failing to report this income can lead to penalties or additional taxes owed. Staying organized with your bank statements makes tax season much smoother. Most common tax form related to FDIC-insured accounts is the 1099 INT. This form lists the total interest you earned during the year. If you have multiple accounts, you might receive more than one 1099 INT. It's important to keep all these forms together when preparing your taxes. The IRS also gets a copy, so make sure your reported income matches what's on your forms to avoid any issues. If your FDIC-insured bank fails, the FDIC steps in to reimburse you up to the insured limit. The process is usually quick, and you'll get your money back, including any interest that had accrued up to the date of the bank's failure. However, you'll still need to report that interest on your taxes for the year. The FDIC's role is to protect your deposits, not to change your tax obligations. When a bank fails, the FDIC pays out the insured amount, including any interest earned up to the date of failure. If you receive this payout, you'll still need to report the interest portion as taxable income. The FDIC or the acquiring bank will provide documentation showing how much interest you earned. Make sure to keep these records for your tax return. The principal amount you receive from the FDIC is not taxable since it's simply returning your own money. However, any interest included in the payout is taxable income. This distinction is important when you're preparing your tax return. Only the earnings portion is subject to tax, not the original deposit. Own accounts are also covered by FDIC insurance, with each co-owner receiving up to $250,000 in coverage. When it comes to taxes, the interest earned is typically split between the account holders. Each person is responsible for reporting their share of the interest income on their tax return. Make sure you and your co-owner agree on how to divide and report the interest to avoid confusion. Business accounts are also eligible for FDIC insurance up to the standard limits. The interest earned on these accounts is taxable to the business, not the individual owners. The business must report the interest income on its tax return just like an individual would. Keeping accurate records is essential for both insurance and tax purposes. Trust accounts can also be FDIC insured, with coverage limits depending on the number of beneficiaries. The interest earned on trust accounts is taxable to the trust or the beneficiaries, depending on how the trust is set up. It's important to consult with a tax professional to ensure proper reporting, as trust taxation can be complex. Certain retirement accounts like IRAs can also be FDIC insured. The insurance covers the deposit amount, but any interest or earnings are still subject to taxes, depending on the type of retirement account. For example, traditional IRA earnings are taxed when withdrawn, while Roth IRA earnings may be tax-free if certain conditions are met. Some FDIC-insured accounts, like certain retirement or education savings accounts, offer tax deferral on interest earnings. This means you don't pay taxes on the interest until you withdraw the money. However, the FDIC insurance itself doesn't affect the tax treatment. Those rules are set by the account type, not the insurance. In addition to federal taxes, some states also tax interest earned on FDIC-insured accounts. The rules vary by state, so it's important to check your local tax laws. You may need to report interest income on your state tax return, even if you've already reported it federally. Being aware of both federal and state requirements helps you avoid surprises at tax time. FDIC insurance does not provide any tax deductions. The insurance is simply a protection for your deposits and does not affect your taxable income or offer any tax breaks. If you're looking for ways to reduce your tax bill, you'll need to explore other deductions or credits unrelated to FDIC coverage. Similarly, FDIC insurance does not qualify you for any tax credits. Tax credits are specific benefits offered by the government for certain activities or expenses, but simply having FDIC insured accounts does not make you eligible for these credits. Your tax liability is determined by your income and other factors, not by your insurance coverage. If you fail to report interest income from your FDIC insured accounts, you could face tax penalties. The FDIC insurance itself doesn't protect you from these penalties. It's your responsibility to accurately report all taxable income, including interest, to avoid fines or additional taxes owed. FDIC insurance only applies to deposits at U.S. banks. If you have accounts at foreign banks, they are not covered by the FDIC, and the tax rules may be different. However, you are still required to report any interest earned on foreign accounts to the IRS. Always check the rules for both insurance and taxation if you have international accounts. You can increase your FDIC coverage by spreading your deposits across multiple insured banks. However, the tax treatment of your interest income doesn't change. You'll still need to report all interest earned no matter how many banks you use. Each bank will send you a separate tax form for your interest earnings. If you name beneficiaries on your FDIC insured accounts, the insurance coverage may increase, but the tax treatment of interest remains the same. Beneficiaries are responsible for reporting any interest income they receive. The FDIC's role is to protect deposits, not to change how interest is taxed for beneficiaries. When you inherit an FDIC-insured account, the principal is not taxable, but any interest earned after the original owner's death is taxable to the beneficiary. The bank will issue a tax form for the interest, and the beneficiary must report it as income. Understanding this distinction helps avoid confusion during estate settlement. Most FDIC-insured accounts are taxable, meaning you must report interest income. However, certain accounts like Roth IRAs may allow for tax-free growth if specific conditions are met. The FDIC insurance doesn't determine taxability, the account type does. Always check the rules for your specific account. Make tax season easier, keep track of all your FDIC-insured accounts and the interest they earn. Organize your tax forms as they arrive and double-check that all interest income is reported. Consider consulting a tax professional if you have multiple accounts or complex situations. Good organization helps you avoid mistakes and penalties. Maintaining accurate records of your FDIC-insured accounts is crucial for both insurance and tax purposes. Save your bank statements, tax forms, and any correspondence from the FDIC. These documents will help you verify your interest income and resolve any discrepancies with the IRS or your bank. Many banks now offer online access to your statements and tax forms. This makes it easier to download and organize your documents for tax season. Make sure to check your online banking portal regularly for new forms or updates and store digital copies securely for your records. Remember, FDIC insurance covers up to $250,000 per depositor, per bank, per ownership category. If you have more than this amount at one bank, consider spreading your funds to stay fully insured. However, this does not affect how your interest is taxed. Tax rules apply to all interest earned, regardless of insurance limits. If you're ever audited by the IRS, having clear records of your FDIC-insured accounts and interest income will be invaluable. The FDIC insurance itself isn't a factor in audits, but accurate reporting of your interest earnings is essential. Good record-keeping can help you respond quickly and confidently to any IRS inquiries. FDIC insurance can play a role in estate planning by ensuring your deposits are protected for your heirs. However, it doesn't change the tax treatment of interest income. Work with an estate planner to structure your accounts for both maximum insurance coverage and efficient tax reporting for your beneficiaries. Most tax software programs make it easy to enter interest income from your FDIC-insured accounts. Simply input the amounts from your 1099 INT forms and the software will calculate your tax liability. This streamlines the process and helps you avoid errors when reporting your interest earnings. Interest income from FDIC-insured accounts must be reported by the tax filing deadline, usually April 15th. Make sure you have all your forms and information ready before this date. Filing late or missing information can result in penalties or delays in processing your return. If you need more time to file your taxes, you can request an extension. However, you still need to estimate and pay any taxes owed by the original deadline, including taxes on interest from FDIC-insured accounts. Extensions give you more time to file, but not more time to pay. If you discover an error in your reported interest income after filing your taxes, you can file an amended return. This allows you to correct mistakes and avoid penalties. Make sure to include any additional interest income from your FDIC-insured accounts if you missed it the first time. Reporting your interest income accurately ensures you receive the correct tax refund if you're owed one. Overlooking interest from FDIC-insured accounts can delay your refund or result in additional taxes owed later. Double-check your forms to make sure everything is included. Banks generally do not withhold taxes on interest earned from FDIC-insured accounts unless you request it or are subject to backup withholding. This means you're responsible for paying any taxes owed when you file your return. If you prefer, you can ask your bank to withhold taxes to avoid a large bill at tax time. If you earn significant interest from FDIC-insured accounts, you may need to pay estimated taxes throughout the year. This is especially important if you don't have taxes withheld by your bank. Estimated taxes help you avoid penalties for underpayment and keep you on track with your tax obligations. Taxable event occurs when you earn interest on your FDIC-insured accounts. Each time interest is credited to your account, it becomes taxable income even if you don't withdraw it. Understanding when taxable events happen helps you plan for your tax liability. The amount of tax you owe on interest from FDIC-insured accounts depends on your overall income and tax bracket. Higher interest rates can mean more taxable income, so it's important to factor this into your tax planning. Monitor your account statements to keep track of your earnings. Withdrawing money from your FDIC-insured account doesn't trigger a tax event by itself. Only the interest you earn is taxable, not the principal you deposit or withdraw. However, in certain retirement accounts, withdrawals may be taxed depending on the account type and your age. If you gift money from your FDIC-insured account, the recipient is not taxed on the gift itself, but any interest they earn after receiving the money is taxable to them. The FDIC insurance doesn't affect the tax treatment of gifts, but it does ensure the funds are protected while in your account. Transferring money between your own FDIC-insured accounts does not create a taxable event. However, any interest earned during the transfer period is still taxable. Always keep track of your interest income regardless of how you move your money between accounts. If you take out a loan using your FDIC-insured account as collateral, the loan proceeds are not taxable. However, any interest you continue to earn on your account is still taxable income. The FDIC insurance protects your deposit but not the loan itself. To sum up, FDIC insurance and taxes operate independently. FDIC insurance protects your deposits up to the insured limit, while taxes apply to any interest you earn. The insurance does not reduce, increase, or otherwise affect your tax liability. Understanding both systems helps you keep your money safe and your taxes in order. FDIC insurance is a valuable tool for protecting your deposits, but it doesn't change your tax obligations. Always report your interest income, keep good records, and consult a tax professional if you have questions. By understanding how taxes and FDIC insurance interact, you can make smarter financial decisions and avoid surprises at tax time.